Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, Chief Macro Strategist. Taking out the boring and helping investors focus on what really matters. Hey everyone, we've got a super special Facts versus Feelings this week. Do want to point out this one was focused on AI. Right, a couple of weeks ago, that was all the rage. So Sonu and I went out and got two of the very smartest, best people out there, Kai Wu and Steve Ho. You're going to love this conversation. They are truly two of the smartest people that understand what's going on out there, how it impacts portfolios, how it impacts the economy, how it impacts all of you. And we booked it a couple weeks early, and then, look what's happened. So there's a lot we talk about in this conversation. We don't really get into everything happening in the Middle East because we had to pre-record, because Sonu and I are working on our TAN, probably the time most people listen to this, down at Future Proof, down at Miami Beach. We're down there doing a live Facts versus Feelings down there. So I'll just say there's been a lot of content our team has created about everything in the Middle East. Go to carsongroup.com/research to see our blog. We've been writing pretty much daily, I think, on there. A lot of information can be found there as well. Where else? Oh, Spaces. So on Spaces, Sonu and I have done a couple different Spaces recently on X. You can go to our X handles on social media. We've been sharing those as well for more real-time analysis of what our team thinks about everything happening in the Middle East. But with all of that, this is the latest Carson's Facts versus Feelings. We're going to get into AI like way over my head. I just sat there and smiled. These guys are really smart. You're going to love this one. Enjoy. Take care. Hi, everyone. Welcome to an extremely special edition of Carson's Facts versus Feelings. Ryan and Sonu here. Sonu, this is episode 178, and it took us long enough, but we are going to dive into AI more than you and I ever could. We said, who do we want to have on? And there are two people that we said, these guys know way more than we do, probably way more than anybody else out there. Who are we joined by today, Sonu?
Yeah, we have Steve Ho from Bloomberg and Kai Wu from Sparkline Capital. I mean, I like having both of them here at the same time because, Steve does so much of great commentary and he's very thoughtful about the macro side of things. Mm-hmm. And Kai has that macro picture, but also view into the sectoral picture as well and individual companies. Maybe I'm not going to talk about individual companies, but we'll talk about AI from both the macro perspective, but also, I don't want to say micro perspective, but from, a sector outlook, things like that. So welcome, guys. Thank you for coming out.
Thank you.
Yeah,
Thank you very much for having us.
No, let's do brief intros. Compliance likes official titles, so just make sure you do your official title there. Steve, go ahead and start with your official title in like 30 seconds to a minute. What do you do all day?
Right. Thank you very much for having me. So I'm a quant researcher at Bloomberg, and I do. I work on Bloomberg indices, which is different from what people typically think of Bloomberg as either being, the terminal or the Bloomberg News. I don't do, I have some relationship with the terminal, but mostly and not at all with news. Just want to clarify that. I work on systematic indices, strategies, using ways of constructing factors. I used to work at AQR Capital before joining Bloomberg. So that sort of gives you a sense, the taste of the lineage of my work. And these days I try to leverage Bloomberg data to work, construct sort of in a similar way, capture themes, salient trends in the macro economy, as well as, in the individual sectors.
Good stuff.
You have a PhD in economics.
I do, right? Yeah, from Michigan, 2018. I studied a topic which at the time was not at all relevant, but subsequently became more relevant. I was studying how would the Treasury yield respond to the return of inflation, and what will happen to the maturity structure of the U.S. government debt.
Totally not relevant at all to our time.
Back in 2017, it was very difficult to find an audience for it. But it sounded too, sort of unrealistic, but it seems to have been bit too early.
And then just to make sure, what is your official title over at Bloomberg there, Steve?
So I'm a senior quant researcher.
Okay, got it. Perfect. Awesome. Well, welcome, and looking forward. I want to hear some Cliff stories. I didn't quite connect those dots. We're big Cliff fans around here. All right, Kai, go ahead with your title and what you do all day, sir.
Sure, yeah. I'm the founder and chief investment officer at Sparkline Capital. Yeah, my background's pretty similar to Steve's. I studied economics as an undergrad, didn't spring for the PhD, and then worked for a company called GMO, which is kind of in the same three-letter acronym Quant category as AQR. Jeremy Grantham was my boss.
I worked at a place called LPL. We're all doing these three-letter things. I mean,
I think that's the sweet spot.
Sonu, do you have one, Sonu? Do you have three letters?
No. It was just convex capital with two letters.
I mean,
two words.
Someone might look and think I'm the different guy on this call because I know nothing about AI, but apparently Sonu's the odd bird with no three letters.
There you go.
Yeah.
So went to GMO. Started Sparkline. I'm the founder there. Been thinking about AI for a long time, both as a user. We were trading our own LLMs back in 2019, 2020, before it was cool. And, also thinking about the investment implications for our clients. We managed funds, including ETFs, for our client base. And, of course, the big question of the day, as I'm sure it is for much of your audience, is how should we be positioning for what is likely to be a transformative technology, but, also brings with it lots of pitfalls. Excited to get into this.
Awesome.
You have two factor experts. I didn't realize that. I knew that. It's not that I didn't know that, but I definitely knew that. But I was like, oh, that's very interesting. And the whole AQR connection. A little story, how I first came across Kai wasn't a debate. It was at this conference. It was a virtual conference, which seems apropos for the world we live in now. It's a virtual conference a few years ago where I think it's structured sort of like a debate between Cliff Asness and Kai Wu. So imagine going up against someone like Cliff Asness, right? And Kai was talking about intangible capital at the time, right? Kai, I think that's what it was, right? You were talking about intangible capital. And it's not like Cliff disagreed with you or that you were disagreeing with them, but how intangible value is sort of like a value factor in some form.
I think the debate centered around, he was at the time arguing that, value spreads against growth were at all-time wides, and that, would potentially imply higher expected returns moving forward for that factor. I think there are a couple arguments. One was around the, intangible capital that the sector mix, for instance, the definition of value has transformed so much over the past several decades that, comparing today's value index to where it was 10, 20 years ago was not as useful. So there's the intangible angle. The other angle was, by the way, machine learning and NLP, natural language processing, where, we actually explored a little bit on that. And, it does feel like they're at AQR now doing a lot. And I heard Cliff on a podcast more recently saying he's kind of changed his mind on the whole machine learning thing. And, to his credit, of course, been incorporating a lot more ML and natural language processing in particular. Which is really cool. So, that was a fun discussion. And, Cliff's obviously way more articulate and charming than I am. Glad to be on the same stage as him.
So funny story. So Cliff, I think last year was our #1 viewed YouTube video of this podcast. So you guys have your work cut out for you, but Cliff is great. So Steve, let's start high level. This is one I've kind of wondered about. What is something about AI that is coming, let's say within a year or two, that maybe nobody's talking about, nobody's thinking about? Is there anything really cool that you've seen that it just isn't out there yet? This is something that excites me. What do you think?
Well, first of all, I mean, I'm not an AI researcher. I am an extensive user of AI, and I use AI to code. Sort of the first AI moment. When people talk about, first of all, just to back up a little bit, right? AI is a very loaded term, and we are seeing the latest iteration. It used to be, machine learning. There have been different paradigms, algorithms. The latest generative AI, based on large language models and transformers. This is sort of what we are currently today talking about as synonymous as being AI. But of course, it's a much broader concept than that. I think the biggest thing that still has not, I think, been quite grasped yet by the broader public is how much bigger demand for AI and compute is going to be. And the primary reason is because most people are not coders, right? And the reason I became aware of this was, you had the first moment of ChatGPT in November 2022. Everyone can relate with a chatbot. You can ask a question, you get some answers, and answers very sounds very much like a human being, right? It's very friendly. OpenAI trained their model to sort of answer in a particular way that really makes you go, oh, wow, this is something different. Now, there has actually been a second ChatGPT moment that happened sometime around also late last year. And this was when, or also around November, when Claude, right, when Anthropic released the latest Claude model, which just absolutely, sort of blew up this concept of AI agents, which we could dive into detail later. But you can actually see that's also the very moment when you saw software indices and industrial indices just took a complete divergence, right? Software, stocks started selling off very hard, and this is this whole discussion about apocalypse and how AI vibe coding is going to disrupt software. And then industrials keep on marching higher. I think that embeds, market is actually telling us something that maybe a lot of people have not quite wisen up to, is that because it is code-based, because it is agent-based, the demand for compute tokens is actually just gone up 100-fold, perhaps, right? We're talking about geometric growth, because you're talking about things that is moving recursively, right? Code, writing its own code, and so on and so forth.
Right.
It's kind of like running a loop, right? And that's one angle. I think there's underappreciated, AI demand, compute demand. On the other hand, I also think there's perhaps underappreciated value embedded in the traditionally laggard industries like industrials that have not been exciting for almost over a decade, because those industries historically have missed that trend of productivity boost through the adoption of software, because they are just so sort of physical heavy, and they are operated by people who have perhaps not been the most sort of technologically savvy, and also they tend to operate in the physical world, and the data is not well structured, and so on and so forth. Now, if you bring AI into a world, in economic concept, the marginal product, right, the marginal return from applying, AI onto data set that industrial companies produce day in, day out, that have not been, harvested and put to good use, you get a lot more bang for your buck than you will get from a company that's already pretty highly efficient, that may gain further efficiency from, AI adoption. So those are just sort of my two, observations, and maybe Kai has, other thoughts.
There's so many ways to go. I'll definitely want to come back to that industrial thing. And, you wrote about in your 2026 outlook, which it's on your X feed. And I really enjoy reading that. But I want to connect this to something Kai posted on his X feed yesterday. It was related to a post from Paul Kedrowski. And Kai, you were talking about how these models itself, your ChatGPTs, the basic models are sort of being commoditized. But now what's really growing is basically what Steve is talking about, is, these improvements in like what you call orchestration tools, all these agents, right? And the ability of agents to do recursive programming and coding and work on your computer, do everything on your computer that you don't have to do. And talk about that, the application piece of it, and going up that tech stack rather than, improving the model itself.
Yeah, I like Steve's framing of, two ChatGPT moments, right? Obviously, the chatbot being released in November 22, but then, more recently, late last year, the combination of the tooling around Claude Code, right, allowing it to run locally on your machine and giving it kind of various access to, say, web browsing and other things, combined with the better model of the most recent Opus, as being kind of the second, right? Because, for a long time, it's been over 3 years since ChatGPT was released, and it's a fun toy, and it's, fun to look up recipes and ask it questions to make, poems for you and such. But, it wasn't as clear until more recently how this was really going to filter into the economy, into the enterprise, right? And, we saw just this morning the numbers released on Anthropic's revenue, which has been pretty incredible, right? They're crushing it. And largely on the back of the Claude Code, platform they're building. So going to your question, Sonu, around what Kedrowski was arguing, what he said was, look, like, the major unlock in the second ChatGPT moment was not so much improvements in models. Like, yes, that has been happening, but, he observed, as we all know, that there's an increasing commoditization across the different providers, right? In the very beginning, GPT 3.1, which was the backbone of ChatGPT, was by far, order of magnitude better than Gemini, the analogous competitors and other labs. Nowadays, Gemini, Claude, Anthropic's Claude, and OpenAI basically take turns at the frontier, and it lasts for like 3 to 6 months, and they just kind of go back and forth. And then you also have from the bottom up, like disruption from the open source, DeepSeek and other kind of Chinese-based models. Meta somehow knocked themselves out of the game, but I'm sure they'll be back. And so you're seeing this kind of commoditization of the models, right? So it's the competitive market structure is not ending up like a monopoly like so many people predicted a few years ago, and instead is ending up more like this kind of oligopoly where there's a handful of players that are competing in such a way as to potentially drive down the cost of their margins down towards zero. And then what Kudrowski does is he says, all right, well, the flip side of that is where the gains have been generated from is not so much the raw intelligence, which has been kind of commoditized and flatlining, but instead the tooling around it, this orchestration layer, the Claude code. And he kind of draws an analogy to the Wintel era, right back in the kind of 90s or so, when you had the chips and the Intel chips, and then Windows came in, developed the operating system, and for a variety of reasons ended up capturing a lot of the rents and gains at that layer of the stack. Sonu, I think we've talked about this in the past too, around other historical industrial revolutions like the railroads and .com boom, where the kind of pattern we've seen over and over again. And not to say that this won't be different, but if you kind of play the base rates, it's that in the very beginning, the infrastructure tends to accrue value. But as you kind of go through the cycle, it ends up kind of shifting where the value is ultimately captured by the application layer, right? So it's Netflix and Meta that win in the internet era, not the telecoms who were up hundreds of percent in the late 90s and then later suffered a 90% drawdown. And so I think this argument by Kudrowski is pretty interesting because I think we're all agreed here, or most of us are agreed, I would assume, that AI is the real deal and will be a transformative technology. The question is more, how will the value accrue through the stack? I think that's what investors are now starting to debate. The SaaS apocalypse, which Steve alluded to, is an important flashpoint, as is we're seeing a sell-off in Korea and chip stocks as well. So, and memory stocks. So, I think there's a lot of questions around who the ultimate winners will be, with this caveat that so often the lesson from history has been you can correctly predict the macro trends, yet make no money because you positioned wrong and you weren't able to pick the winners. Right. So that's what makes this such a challenging time.
I'm trying to think of an analogy. I wonder, you can tell me if I'm wrong. I wonder if it's sort of like, right now, it's no longer about, I'm sure there is a lot of money and, intellectual capacity being put to this. Like, it's no longer about making a more intelligent AI. It's about how that intelligence is being used.
Right, directing it towards the right purpose. Kudrowski's article talks about nannies, how nannies are so important because you kind of have to guide the children who, have some things going for them, but are a little bit lost without some guidance. And that harness is super important. And even just like routing between models of different intelligence levels and such, is critical to actually, it's like the chassis versus the engine in the car, is another analogy.
So that's great stuff. I love both your takes on this one. This is one. So, you know this, but Carson Group, Sonu and myself and our team, we manage billions of dollars, right? Carson Group is almost $60 billion in 43 states. We work with over 500 financial advisors. So we do get a lot of communications, but we're like, what's the macro part mean to investing? So here's my question, guys, really for both of you. We hear all the time AI is going to be deflationary. I guess my question is, how deflationary is it going to be? But right now, Sonu's seeing some things, and I kind of agree that we're actually in a little bit of an inflationary world right now, maybe for the next year or so. But how deflationary could it be? Steve, do you want to tackle that one?
Maybe we'll connect that to, all right. Kai just mentioned South Korea, right? The Kospi index was up, 60-70%. And then over the last 3 days, down 20%. It's in a bear market. But of course, the index is still up over 20% this year to date, even after the big drop. It's and that comes on the back of like a 70% plus gain last year, right? And of course, there are two big companies that dominate, SK Hynix and Samsung. Not a recommendation to buy any of these companies, anything like that, or even South Korea for that matter. But Steve, I think this gets to something you also wrote, and Ryan's question. As demand for tokens goes up, you need more infrastructure in a way. You need more chips. You need more memory chips, which is what these two companies make, and along with Micron, right? So there's still demand for this stuff. And then what happened in the Middle East this week, connecting it back to that, we are recording this on March 4th, exactly a week before this episode will officially release. All the hostilities, the Strait of Hormuz, that's all closed. It's a reminder that, wait, Samsung and SK Hynix need energy too. South Korea is a big importer of energy. Connecting this back to something you wrote, as I said, is it seems like energy is a binding constraint here, right? Talk about that and, relate that the whole deflation versus inflation thing.
There are different ways of cutting it, and I've been wrestling with this question with a few threads of thoughts myself. I think the technology being deflationary is I think it is a truest statement, right? If you look at the price of a Samsung or of a plasma TV in the grocery store today, what you can buy today with a few $100s, it would have cost several $1,000s a few years ago, and it would be much worse quality. There's just no question that technology is deflationary for manufactured goods, for industries or sectors in which there is easy productivity gains through scaled automation. Now, as to whether or not that means lower inflation in aggregate for say, a developed economy like the US, that's far from clear. There's a timeline issue. There's also a composition issue. The timeline issue in that there is that maybe right now a lot of the deflationary stuff is all in the consumer goods, but the persistent sticky inflation stuff that we are all experiencing and that is politically, I think, troublesome for people is all in the services, because that's labor intensive, right? And there's this concept of BOMO disease that people were talking about. I think Mike Green had that viral tweet, and which is all about BOMO disease, right? It's all about the fact that
like a nanny, childcare.
Exactly,
for example,
a childcare does not experience productivity increase just because over time, you've become more automated at making iPhones, right? A childcare provider can still take care of only at most 2 children or 3 kids at the same time, depending on how well behaved they are. Depending on, and also given the labor shortage, and also urbanization, how difficult, how expensive it is. I mean, these things don't easily resolve themselves until we get actually literally an army, a swarm of robots, humanoid robots, at which point I guess you will have this debate about whether or not you want your kids to be taken care of by robots or real human being, and maybe the rich people will just have real human beings taking care of their kids, and the lesser would just have robots.
I feel like that's already happening. I give my kid an iPad and that's it. The iPad
maybe, yeah. I mean, there is a certain sense of it, right?
I was just going to say, I have an 18-year-old. I don't know how to control her. Robots, people, I don't know. I mean, once they turn 18, I guess she's just got to go off to college soon, figure it out on her own, because she knows it all.
Yeah. Exactly. So to me, this inflation implication from AI seems to me a little bit jumping the gun a little bit, right? I mean, eventually, I can see it coming. For now, I think we're dealing with
the deflationary angle
more practical things, and more practical things is that you've got this geopolitical backdrop, which I think is not controversial, that is all defined by the geopolitical rivalry of the US and China, right? And it's sort of a dance of song of fire and water. And, and the US and China are basically fighting over natural resources globally. China has spent 10 plus years quietly building out a supply chain through the Belt and Road Initiative, having a relationship with developing countries, and having built out this well-diversified supply chain domestically. The US suddenly woke up one day and say, hey, we actually need this stuff and we can't just depend on China. What if, right, it doesn't work out? So suddenly realize that this onshoring thing has to require resources, which means that you have to go out there, not only grab resources for yourself, but potentially also play the chess pieces of cutting off resources that China has been taking for granted, which you can maybe wink, wink, look at what's happening in Venezuela, Iran. Sure. Maybe there is an argument there that there is certain geopolitical calculation. So I'm just, the way I see it is that there's going to be a lot of demand for hard stuff. Right. The reason I brought up industrials, the reason you brought up Korea, for example, the industry that I find most fascinating in Korea, I think memory stuff is fine, right? AI, but if you plot Korean defense sector, right, heavy industry, it's essentially done just as well as a conductor industry. It's not being talked about as much.
Asterisk on that, even over the last 2 days, that's done well, even while these other chip companies are going down.
Because it turns out the US, if it wants to revive its shipbuilding capacity to patrol its waters, to enforce the Monroe Doctrine or whatever, it doesn't remember how to do that anymore, right? Chesapeake Bay, Virginia doesn't remember how to build ships anymore. Koreans do. So Korean Honda Heavy, is going to be a key partner. And for that matter, in my outlook, I talk about how there's going to be a string of countries that will sort of fall into what the US will design as this new supply corridor and a camp-based model of a more security-based, a little bit more transactional, based supply chain, and some countries will be able to supply into it to meet the digital demand. That's kind of how I see it.
To that end, I wonder, and this is for both of you, is Europe underestimated here? Because Europe has a lot of industrial know-how and prowess, and you can argue China's been eating its lunch, right, with the Chinese export sector and energy, and Europe does have an energy problem, as we've seen with gas futures over this past week. But I wonder if there is know-how there. They are an industrial powerhouse. They are the third largest economy, regionally speaking, like 12 trillion or something like that. I'm curious what you think about. I mean, I know, Steve, you've written about, but Kai, you look at companies from you're using your AI, your machine learning models. I'm not going to say AI models. AI means all sorts of things. Your machine learning models to figure out which companies are adopting AI, which companies are getting ROI from it, right? How much are they talking about that? When you look at that, I'm wondering what you're seeing both in Europe. I'd love both your take on Europe.
Yeah, so I think that, Sonu, you bring up a key framework here, which is when someone says, I want to be long AI, what does that mean? Right? It can mean buying NVIDIA and chip stocks, which is, of course, what's worked so far. It could also mean buying the adopters of the technology, right? Companies that, Steve, you brought up a pretty good example of the industrial base, which is being kind of underperforming, not really taking in enough technical talent. There's a lot of potential value that can be realized there, right? That kind of old economy play. AI has the potential to unlock a lot of value. We talked about, this unstructured data revolution, which is when we invented the Excel spreadsheet, we are now able to take structured data like time series and such, and now do analytics on it and get value out of it. However, as you pointed out, Steve, a lot of the value that corporations have internally is unstructured data, which hasn't really been accessible. But now with AI, we can now unlock that. So that becomes a really interesting angle. I would extend it also to the services. This is getting a little bit off topic with the services component. Like Steve, you talked about massive deflation in TV sets, which is true. But I think there's also an argument to be made that the whole point of AI is now we can start pushing down the cost of lawyers and medical services, the parts of the CPI basket that have been inflationary. In addition to the industrials. But going back to Sony, your point, if you look at the world and saying, I just want to be long AI with regards to the infrastructure builders, then just buy US stocks, aside from ASML and TSMC and some of the other Korean and Taiwanese chip, hardware producers, that's where all the action is. But if you're willing to say, you know what, I'm willing to now consider second order beneficiaries of AI, right? Thinking of industrial companies or services businesses that can potentially benefit from the progress that we mentioned around Claude Code and the expansion of those tooling into, kind of the Codework suite into Excel plugins and, legal services and wealth management, right? That could be really interesting. And when you think about it that way, Sonu, you're spot on, which is, Europe doesn't have, aside from ASML, any exciting, AI first orders, but there's a huge industrial base, really strong brand equity, a lot of customer relationships, and quite frankly, their valuations are cheap, right? They've been underperforming for over a decade, and their PE ratios and such are still very, very much reflecting a continuation of that kind of malaise. And to the extent that AI may even reset expectations somewhat better, right? The margins of these companies somewhat improve, right? That could potentially be a huge catalyst. I'd say Japan is seeing something similar, based on the demographic, headwinds that they're facing. They've been kind of early to it, like Korea as well, to embrace robotics and kind of automation and adoption, because they have no choice but to do that. They don't have the immigration and the population growth that the U.S. has enjoyed, for many years. So yeah, I think you're spot on. If you're willing to be a bit more, long term with how you're thinking about the way the value will kind of flow through the through the economy.
Yeah. So I very much agree with what Kai just said. The framework I apply to AI, the implication also for investments is similar to AI, what Kai was just mentioning. It's a multi-layered one, right? I think multiple leaders in the industry have mentioned the same thing, Jensen and Satya, right? You've got your sort of application layer, right? Companies that make use of AI and produce things that eventually become valuable. It's not quite clear yet who the beneficiaries are. what we have seen so far for sure is that because there's going to be this massive amount of compute, things that will be necessary input into the compute have been net beneficiaries just because you've got this thing that's cyclically going along. There's a limited supply capacity. Suddenly there's a massive demand. And we know it from Econ 101, right? Supply curve is vertical. So demand goes up, price has to adjust. So you've got your chip layer, compute layer, the things that test the chips, or the random agents. I think I even saw this week, Toto, the toilet maker, has benefited from their ability to apply ceramic coating or something, right? For what is called electrostatic chucks or whatever. So that's the framework.
I didn't see that, but I'm not sure I want to talk about it. But I am very curious. I'm going to look that up.
Yeah, they basically the AI trade so far, so to speak, the biggest beneficiaries, the winners, have all just been the picks and shovels of what goes into the construction of a data center, right? From the chips to the things that house the chips to the energy, for the cables that transmit the data, the most random wires. Companies that used to be viewed as terrible companies that used to operate in low margin cyclical companies with a very cheap valuation because the demand is so pro-cyclical, suddenly are seeing a massive amount of demand. Like you've got these random companies that make literally optical wires, like Ethernet cables, right? And they used to be viewed as, for lack of a better word, shitcoins, right? Because they were money losing and they will go through periodic, sort of consumer recession. And then suddenly, oh, wow, we need tons and tons of these cables. And there's only a handful of these suppliers that have been vetted by the hyperscalers. And suddenly they're making printing money, right? That's the context within which I think about a company anywhere, not just Europe, Japan, Korea, right? For example, right? In Europe, one of the best performing companies has been Siemens Energy, right? And also Schneider. They make literally what is called transformers, not the LLM transformers, but the old school electricity transformer that take your high voltage electricity, low voltage electricity, and pass it on to the data centers. Those transformers are booked out in terms of supply into 5 years out or something, right? It's the same. In the US, you have GE. In Europe, you have Siemens and Schneider. And within this context, the industrial electric equipment suppliers are all suddenly seeing this massive demand squeeze, right, on their limited supply. And to that extent, there is industrial capacity in Europe. There is industrial capacity in Japan. It kind of almost doesn't really matter whether or not those individual local economies are doing well. And manifestly, European economies still not doing that well. But the top of the stock market in Europe are responding to global demand, in particular, the AI trade. So that's how I think about it. But I do actually see a broader bullish angle. So I mentioned in my outlook that I was very bullish on Europe because of this sort of spillover global demand for AI infrastructure. But I think the bottom of the market, or the mid cap of Europe, might actually benefit from the fact that Europe seems to be finally realizing that new geopolitical picture requires them to actually wake up and do things on their own, right? Because defense-wise, this is not just a one-term thing, right? The US is moving away from its traditional sort of defense umbrella. So Europe has to spend more on defense. Europe has to spend more on industrial capacity, energy, onshoring, and so on and so forth. That actually could be beneficiary to companies that sit in Europe and service Europe.
Well, about a year ago, we were talking about those things on our team, and for that reason, we went into a little bit more developed international, and obviously it's worked out well. I mean, Kai, more of a markets investing question here, hopefully. We know software struggled, right? Now, again, we are doing this on March 4th, so who knows what's going to be happening a week from today, to be honest. But
software has actually been rallying the last few days.
Yeah, that's what I was going with. Software's up 5% the last 5 days. And the time we're doing this, obviously, market's been hit hard after all the drama and all the everything in the Middle East. Do you like software here and now? Are they all just going to go away? And is there another sector out there that's going to be hit hard by AI like software just was? I know there's a lot of questions there, but maybe let's start there. What do you think of software names right here? Go ahead,
crystal ball out.
Yeah, get that crystal ball. Yeah. We bought some software in our models a couple weeks ago. Like, okay, so fingers crossed. So far, so good. But what do you think? Yeah.
Look, I think that the competitive dynamics of the software market have changed. There's no doubt about that. But I think the common kind of viral narrative that, Salesforce and Workday and all these kind of stalwarts are, justifiably down 50+%. I think that misses an important point, which is, enterprises don't buy software because they want code, right? Because, I can't code this myself, therefore I'm going to hire Salesforce, right? What they're really doing is they're buying brand, they're buying support, they're buying legal, like someone to throw under the bus if things go wrong.
Probably because they like the sales guy. They went for a good lunch.
Yeah, maybe they like the Nobu steak, right? I mean, if you think, you invert it around, right? Which is like these big enterprise software companies, their moat was never their software. If you've used any of these products, like the UI is not even that good, right? Like, their moat was never. I have that. Right. Like you can go find any startup like in Silicon Valley 10 years ago that could deliver a better kind of user experience than these companies. But the reason why those companies have failed to, penetrate is because the big enterprise software companies have the distribution, the sales, the brand, the network effects in many cases too. And I don't think that that's being disrupted. So to the extent we're talking about like the software index, like the cap weighted software index, I think it's like IGV or something that includes, large caps. I wouldn't be so quick to write off the incumbents from here. And, that's not even playing out this dynamic situation where, by the way, guys, these companies can also adopt AI and Salesforce and many of them are aggressively trying to do that. Right. So it's not, people for a long time thought Google was dead because of ChatGPT. Oh, yeah, we're not going to use search anymore. We have AI. And guess what Google did? They just incorporated Gemini across their entire product suite, in their, massive distribution. There you go. Like that's, kind of solving a lot of the problems. So I think that would be my view in general. I do think that like any disruptive period, you tend to see more dispersion. And I'm actually studying this. It's empirically a fact that when the crosshairs of, creative destruction set their eyes, they're like, Sauron's gaze on your industry, it does create more dispersion, more winners, more losers, and it kind of reshuffles the deck. But it's not clear to me that just because that's the case, the average will necessarily change if you're buying an index, or that like the startups versus incumbents are necessarily advantaged, right? You think about, past disruptions. Sometimes it's like the Walmarts that actually end up victorious, when they were, amidst the e-commerce retail apocalypse, they won, and they're a big company, and it was many of the mom and pops who suffered, right? We may see the same in banking. So that was your second question, Ryan, which is what other sectors are at risk. So a few years ago, I did an interesting research paper, and what I did was I looked at the labor force of every single company, so at the firm level, and said, look, each company has 1,000 workers, and these guys do this and that, like customer service, manufacturing, so on and so forth. What you can do is for each job, you can unbundle it into a series of tasks, and so that task might be talking to customers, it might be putting data into a spreadsheet. And for each task, you can then say, how exposed is that task to large language model automation? So for example, like, customer service is a pretty like automatable task with, voice and such, whereas like talking to clients, taking them golfing or to Nobu, not automatable. And you can then kind of rebuild that at the individual employee level, and then roll up to the firm level, and then roll up to the industry level. To say at the industry level, what percentage of tasks are, LLM exposed versus not. And it's really interesting because it creates like a nice hierarchy which makes a ton of sense, where software is kind of the most exposed one, and other technologies. And then financials like banking and insurance are really high, as you might expect, right? I think Intuit or like H&R Block, these kind of tax prep guys, are individually amongst the highest, right? And then it goes all the way down to like, I think Chipotle was the lowest, right? Like, and companies in the restaurant industry, you can't really automate that yet without, advanced robotics. And what's interesting is you can then map that against what we're seeing in terms of what companies are investing in with regards to AI. And there's a nice relationship there. Like if you do a scatter plot, the correlation is pretty strong. In other words, companies in disrupted industries are working harder. They're not dumb. They understand this is coming, and they're working harder to invest in AI in order to kind of stave off these threats. There's, of course, going to be some outliers. I think I noticed it was like regional banks were a little bit low. Pharma was a little bit low relative to where it should have been. And that's probably regulatory issues.
Sure.
But in general, you do see this nice relationship. So I think the markets are pretty dynamic; they're pretty efficient. Like I think this viral narrative against like SaaS stocks, oh yeah, software is dead. Like everyone's just going to vibe code their own thing. I think it misses the fact that there's like a competitive response that is elicited by these companies that will then attempt to adapt and perhaps use their incumbent status in order to deepen their moats with AI.
Let's get to we'll bring up the Citrini research article. Brian and I talked about this a couple of weeks ago. Steve, actually, I believe you know those guys, even, and you've seen the piece before the rest of us do. We don't have to debate it and stuff. But one thing they mentioned in the piece, which is sort of like scenario analysis, this is not their base case, right? I think a lot of people forgot about that. But still, one thing they wrote is, we had and this is from the perspective of writing this memo in June of 2028. Right. And this is what they write. We had overestimated the value of human relationships. Turns out that a lot of what people called relationships was simply friction with a friendly face. Right. And which is actually like a great thing. That was
very well written. Yes, very well put.
Right. Yeah, exactly. But then it gets to Steve. You don't have to talk about this if you cannot, but you're at Bloomberg. And every 2 days, somebody on X is like vibe coding away. Oh, here's a Bloomberg terminal replacement, right? Like, and I'm thinking, I don't think that's going to work out very well.
I have to say, I commend the Perplexity folks in terms of their gradual learning, understanding of what the Bloomberg terminal is. And I think it started from a pretty rough place of thinking it was just about plotting a stock price chart. Now they are evolving towards, maybe it's a dashboard, maybe they're putting more and more features onto it in terms of what they're calling a disruptor. But I think it is, I'm not going to opine on it because I just don't know, right? Because I don't work with the terminal. I said at the outset.
I'll say this, like for the terminal, like I'm not a bond trader, but I know a lot of people who trade bonds and fixed income. You see the prices there. That's something you don't get normally. And then you pick up the phone and call somebody on, someone else's desk to get a price, right? To see, like, it's to corroborate what you see on the screen. But you need both. You need the relationship.
Exactly. Too. I think to respond to say something about the Citrini piece, right? Which I know those guys, a decent bit, and I didn't really fully agree with it. Obviously, they don't think of it as a base case, but I also think it's actually less likely than they were even projecting. But I wanted to speak it within the framework that Kai was just talking about. That it goes back to whether or not there's this concept of frictions, right? And we don't know how much friction there is, but we do know that in the real world, there's a lot of friction when it comes to trying a new thing, right? There's a time to learn, there's time to adopt, and there's a time to build it into your workflow and let it be scalable, right? And there's also the risk of compliance, the risk of risk management. You can't really have something that works 99% of the time and just have 1% of the time it goes terribly wrong. So all of those things being considered, there's going to be some delay between having a program that runs and the software that works. There is a difference, right? A program that runs, a runtime that runs, for someone, especially for people who don't code, right? They feel supremely empowered, right? I see my colleague Joe Weisenthal out there vibe coding software. He doesn't code, right? So to him, someone like him, it is extremely empowering to see yourself writing a script that sort of produces an outcome. Now, to translate that into a scalable institutional enterprise solution that solves a problem with meaningful amount of money behind it, there is a substantial amount of gap. And the debate lies in how much friction will there be and how long will those frictions last. And there's a great deal of uncertainty. And I think in any given moment, we could be making the mistake of assuming, too little resistance and way too much resistance of the status quo, right? I think that's where the uncertainty is. And the reason software sold off, I fundamentally don't think is because people, anyone genuinely think they're going to be vibe coded and made obsolete. It's more the valuation question. They were priced as though they were going to continue growing at a steady rate with sticky revenue, with very high gross margin because the software business into perpetuity. So you price it almost like a perpetuity as you would. Now, as you know, any long-term bond suffers from duration risk, right? If it's a longer duration, if you have a small movement in the assumption of the yield, you give a big, valuation change. And that's, I think, the analogy I have for software is kind of like what happened to treasury bonds, TLT in 2022, right? It's not that we think bonds are going to go away, right? It's that bonds are not going to have the same valuation they did pre-COVID in the ZERP era as they do go forward, right? We still think bonds are going to have a bonds here and now and then. Like, I think most recently, some people are talking about buying bonds because they think the economy is going to slow. Bonds is still going to provide a recession hedge. That does not mean that bonds are going to trade at the same level as they did in 2021. I think that's how I see software. Software has been permanently impacted by this threat of competition, of there being a capability of vibe coding an alternative that maybe does not work quite as well, but works nevertheless, that allows you to negotiate with a software provider vendor when it comes to pricing. That does
and
not
I guess
mean,
even
though,
tenure of the contract, right? Like our chief strategy officer, Danny Fowler, talked about this recently about like, whereas previously, and this gets to the duration bit with comparison to bonds, instead of signing a 5-year contract with a software company, like, wait a minute, I'm just doing it for 1 year.
Indeed. So it changes the economics of the model. So that's why, sort of in the short term, you can think of software having a bonds, a trade, and whatever, maybe the market was oversold it and whatever. But longer term, the reason I keep going back to this idea of industrials and harder things is that it is pretty damn hard to vibe code a ship,
One would think, or a submarine,
right? What you can do though is that there's a lot of defense software, right? And I think when it comes to anything that comes to a government, military, and so on and so forth, you can assume perhaps there's a spectrum, and there's going to be some resistance, more friction here and there, and there's probably going to be more friction over there, right? So even when it comes to software in that space, there's probably more pushback, and same thing with healthcare. So I think of the whole thing as being on a spectrum, and the more sort of physical, the more sort of regulated the space is, perhaps there's going to be a slower rate of adoption, but there's no question there's just been a paradigm shift.
Anecdote from my history. I'm not an engineer anymore by any stretch of the imagination. That's my background, but I did computational fluid dynamics, and this was over 20 years ago.
Wow.
Right?
Navier-Stokes?
Navier-Stokes, and modeling it out. And originally, like, I had come into the industry during a period where this is late 1990s, early 2000s. We were like, you know what? Computers can solve these equations. We can do Monte Carlo simulations. We can model turbulence behind airplanes, turbulence behind, Formula One cars to reduce drag, right? We don't need wind tunnels anymore, right? We don't need all that experimental stuff. We can just do everything on a computer. And guess what? We couldn't. And this is like, we didn't even have, one big constraint was computing power. We didn't have enough computing power. I still don't think we have enough computing power to completely model the flow of air around an airplane. Right? Or an airplane moving through air, which is why, what they do? They still send the planes, experimentally, let's throw a, model prototype in the air, metaphorically, in a wind tunnel. Formula One cars, design and testing, they still use the wind tunnel. It's not all in the computer, right? And that gets to the idea that, we still have to build stuff.
Listen, if you remember the beginning of Top Gun Maverick, the movie a couple years ago, in the very beginning, Tom Cruise is up there and goes like Mach whatever, because they said it couldn't do it. He said, I'm going to show you I can do it in my airplane. And he did it. Listen, we're at the top of the hour. Are you guys okay to go a little longer? I know we booked you for an hour. You guys okay? Or
I'm fine.
Seriously? Okay, let's go 15 more minutes. We'll go 15 more minutes in. Kai, you haven't spoken in a while, and I don't even want to ask you a question. What are we missing? What do you want to talk about that we should hit on here these next 15 minutes?
Well, look, I think the thing to think about that we haven't talked about yet is timeline. I feel like that a lot of the discourse, will change based on what period we're talking about, right? So oftentimes I'll hear people posting, oh, wow, like NVIDIA's revenue has gone up again, right? But of course it's gone up, right? We already know, we have visibility into what's happening the next few years. As Steve, you said, there is a bottleneck in, compute and that supply chain that won't resolve for a period of time. We know that's a fact. That's always been the case. So I think we should be thinking about what is the trade or how does the economy look? Is it inflationary, deflationary the next year or two, while we're supply constrained? And then as we look further out, the questions, revolve more around what's like the long-term, case for, how different sectors their competitive dynamics will change, such as software. What is the case for how fast diffusion moves to the economy? I agree with everything that's been said around, the pace being gated in many cases by physical constraints, assuming robotics is down the line, as well as regulatory constraints. Not necessarily saying you don't want to invest in non-protected industries, right? If you can pick the winners, then yeah, you actually want to be in those sectors, and you want to stay away from the kind of insulated sectors because there's no trade there. And I think the question then is of course more around, how are markets priced? Because I think, as a value investor, the key becomes, not being able to just say what everyone else already knows, but trying to figure out where things are mispriced. I think, the Europe example, the kind of old economy industrials, some of the obvious supply chain things, you mentioned like, Siemens and GE Vernova, are potentially interesting opportunities. Healthcare is of course very interesting. It continues to be interesting. I think that part of the discussion is kind of underappreciated. Most people like to focus on technology and software, whereas a lot of the opportunities and upside, I think, in AI, spreads more deeply. And then the whole question around labor disruption and such, I think it is again largely a timeline question, right? If you go back the past several centuries and look at the history of disruption, if given enough time, things kind of tend to work out. Things get really tough when the timeline's compressed. If we do see, as the security article posited, this play out in 2 years, then yeah, we're going to have a lot of problems. The government may not be able to respond fast enough. Employees may not be able to reskill fast enough. Companies, will have to lay off people. I can see that being the case. But to the extent that it takes longer than that, which I think is, I think the folks out in Silicon Valley, I heard Dario Amodi talk on the Dwarkash podcast about his timeline. It was very, very, I think, not naive. I think
kind of misses, head of Anthropic, right?
I think it kind of misses the idea. When you work at a real company, things move very slowly. There's a lot of politics. There's a lot of institutional knowledge that needs to be broken down. Diffusion doesn't happen in 1-2 years, even if the technology is capable of doing that. And I think that's in a way kind of a saving grace, right? Which is what matters is two things. One is point A to point B. What is the step change in terms of what the technology is going to do? But second is the path dependency component, right? It's kind of the integral under the curve idea, which is if you get the adjustment overnight, it's a huge shock. If you get it spread over 200 years, whatever, you barely even notice. It's the boiling water and the frog. So I think the timeline matters a lot. And I don't think there's enough discussion around trying to kind of pinpoint what that number actually is, right? Because again, the outcome is very different if it's 2 years versus 10. If you look at the historical data on this, right, you can look at the history of these S curves, right, electricity, automobile, et cetera. They have been accelerating. So I think one thing to pay attention to is the fact that a technology may have taken 20 years to diffuse, 100 years ago, and then 15, and then 10, and it is accelerating. I think that's something important to note. But I think there's still a limit in terms of how fast things can move. And then there's obviously other governors, such as the government saying, hey, we have regulations, and the compute constraints themselves, right? So here's another thing, which is in order to actually get this security outcome, you need a 1000x increase in your compute. But we just said by definition, you can't do that, right? That's not even a possibility unless models become way more efficient. And if they do, maybe you don't even need the compute. So I feel the discussion is focused a lot on the end game and kind of misses the path that we take to get there, which is
how long
as important,
it takes
if not even more important. Yeah, exactly. And kind of how that path kind of winds and bends and arcs over time.
I want to connect that to something that we all do, which is manage portfolios, think about portfolio construction, sectors, asset allocation, and stocks as well, right? When you're doing factor research, time horizon is very important. Right. Usually when somebody's on X, you always see this, buy this, sell that. It's but what's the time horizon? Right. And nobody ever talks about that. Not to mention risk management and stops and things it's a whole other thing. But on that question of you guys mentioned, this could be a period where there's a lot of dispersion in terms of adoption, but even within companies. Right. And this is a tired phrase. I don't like using it, but I will, which is that, it's an active stock pickers market, right? I hate that phrase, but still, I wonder if there's, broadening it out. Is this a period where that's good for active management, as defined very loosely, versus passive? What do you think, Steve?
I do think so. So just to pick off pick up where Kai left. Kai was talking a lot about timeline. We want to talk about space, right? Horizontal space. To the extent that we were just talking about this being a stock pickers market, stock pickers market to me just means that the overall market isn't going anywhere. And if you pick correctly, you did really well. If you pick incorrectly, you did terribly, right?
And on average, it's flat.
It's correct. And if you look at the US market, that's been the case since last October.
Yeah.
Some pockets of the market have been ripping, and some pockets of the market have been absolutely decimated, like software. And on the average, you get this thing that's just sort of grinding horizontally, doing not very much of anything. And to the extent that we're talking about sort of selection, I actually want to broaden the space a little bit. Last year, it was actually the US didn't do very well aggregate. It couldn't find a market that did more poorly than the US, actually. EM did really well. And I'm actually currently writing an article that I'm about to put out, somewhat imminently, looking at EM. In particular, a look at what I'm calling it the economic price of freedom. I'm talking about the freedom as a factor, right? So if you look at EM total index, it's actually outperformed the US by some 25% over the last year, well, before the most recent sort of sell-off. I think that the order magnitude is about the same. And then if you look at the democracies within EM, the countries that are viewed as being more democratic, right? Korea, for example, is actually the democracy. Brazil, India, and so on and so forth. Those countries have actually outperformed the US by another 60%. In other words, there's a massive gap between different types of EM to the extent that we have this accidental rotation out of the US, out of the super growth momentum towards a bit more value-y, a bit more sort of, gritty industrial, materials type of a trade. Is actually happening along this very, I would say, latent factor. And the reason I posit is because democracies happen to align with where the US wants its new supply chain to be, right? To the extent the US is going to move supply capacity out of China, out of some of these less reliable historical point in time, supply chain, they're going to want to move it towards countries the US could trust, that has rule of law, that has the ability to enforce contracts. And I think that's why we're seeing a reaction. In other ways, everything has become all sort of the same trade. They're just different manifestations. So to the extent that you are looking at benefiting from this AI build out, and there's uncertain timeline, there's uncertainty over intensity and quantity, what you do know, there's going to be a ton more demand for copper. So you want to probably have exposure to that in a foreign country that apparently is priced quite cheaply, right? So there's a bigger operating leverage to the theme by having exposure in unexpected places that people are not necessarily looking at. The US is very over-owned, not just by American investors, but foreign investors, because of what's happened over the last 10, 15 years. Every single pension fund globally probably is over-owning US, especially top of the market quality momentum.
It's like a momentum trade, right?
Exactly. And it also so happens the momentum is coinciding with quality because these companies are all profitable. Right. That's why I kind of find that that's actually one thing people are probably not quite paying enough attention to, despite the very high returns that have already been accrued to these countries, that there is actually a lot more to be, I think there's potentially a lot more, interesting stuff happening outside of the US.
So this was episode 178. We're not done yet, guys. Episode 178 of Carson's Facts versus Feelings. This has been an amazing discussion. Look at the timer. We need to stop. Probably one more question for each of you, if that works, because we could go all day. Kai, one thing I like to ask this question a lot. You started your own company, right? So a lot of financial advisors listen to this. Sonu and I work with literally some of the best financial advisors in the country that are really running their own business. What are some things you've learned over the years starting your own company that most people probably wouldn't even think of before they actually are, in the cockpit, so to speak, and in the line of fire?
And especially today as well, we're literally talking about
AI. With AI
and even like adapting to new technology while keeping your customer base and trying to grow that.
Yeah, look, I think AI is like this massive force multiplier, right? People talk about these billion-dollar companies, like the OpenClaw guy who reportedly got $1 billion payout for basically by himself creating an open source repo. Whether or not that number is correct, I think the trend is in that direction. where individual contributors, people who have either a creative idea or good relationships or some asset, right, that's underappreciated, can build an organization around them with technology that was impossible even several decades ago. Think about before cloud computing, you had to build your own server rack, and unless you knew how to do that, that would be really challenging. You had to manage your own back office, right? We have outsourcing and such. So I'd say that you definitely want to lean as a kind of small business on your strengths, like figure out what their strength is, and then lean on that. And then I guess the question is how best to deploy, how to deploy AI and technology. I mean, I've written extensively on this topic of the AI financial analyst, where I talk about how disruptions in technology often go from the bottoms up, where AI hallucinates, it's not perfect, it has a lot of problems. So you probably don't want to give it your most mission critical task and then step aside and let it do its thing. That's probably not a good idea, and you're going to end up in jail if you're a registered advisor doing that. But instead, think about the task that you may outsource to a paraplanner or an analyst, or maybe even a data science team or an IT team out, say, in a different country. Those are the tasks that you're going to look over anyways. And, it's okay if there's some mistakes, if it's, 10 times cheaper and 10 times faster. So, my advice is always, when you experiment with a new technology, figure out what those things that you are just repetitive kind of automated tasks that are generally low stakes and occur in volume, apply the tools there. And then, over time, as the technology improves, you can always, kind of go up the stack. Right. So, for example, AI coding, I was not an AI coder. I didn't use that technology from day one. Right. I guess I was a late adopter, in terms of that. I use it extensively now. It's basically when I used to run a hedge fund, I had, some guys who were, PhDs and master's folks who were basically my analysts. And I'd say, hey, I want you to run this experiment on the data, run this back test, take a look at this. I want you to fix this pipeline. It's starting to break. Can you just monitor it and tell me what happens? Those are things that as a small organization, I don't have those resources, right now, but, I can have Claude Code do that sort of thing for me, these little agents. And it's, kind of the same experience in many, many ways. And again, it wasn't something that I said I'm comfortable doing 2 years ago. It's really only been in the past few months that the models have gotten good enough to now take that next step from being, say, a research assistant to an analyst. To a quantitative analyst, let's call it. And then, over time, we're going to see more and more improvements and just kind of, build for that future, but, be conservative with regards to, how quickly you're willing to jump in and embrace some of the downsides as well of these technologies.
And then Kai, quickly, how can people find what you're up to? Well, where's the easiest way to find what you're doing?
Oh, yes. You can go to my website, sparklinecapital.com. I have all my research pieces published there. And I'm also on LinkedIn and Twitter at ckaiwu. That's my handle.
Perfect. And then Steve, we mentioned this earlier. I love the one about mentors, right? Obviously, work with Cliff at AQR. I don't know if there's something you learned from Cliff at AQR, like a mentor in the industry and the incredible Bloomberg network. Something you've learned from someone over the years that you want to share with the listeners before we sign off.
So I've sadly never had the fortune of directly working with Cliff, okay. But I did work with some very good mentors when I was at AQR, and one of them I won't mention his name, but I've actually had the fortune of keeping up over the years. I've actually learned one of the biggest things is you always want to simplify. There is a tendency of I think especially in the quant world want to mask or substitute complexity for sophistication. Most of the time, something that works, is exposed obvious, and there is always, some ways of, and a lot of times people are too embarrassed to, admit that there is a much simpler, approach to getting roughly the same outcome or even better outcome that's potentially more robust. So that's something I have learned, and more generally, just be very open to, hearing people, his opinion from all corners and translating ideas across fields. That's one thing I've benefited a lot from being on Twitter.
Wow, that was good. Sonu, any final comments from you, then I'll bring us home.
No, I what you guys mentioned at the end, I keep thinking about one thing I've been grappling with. I'm just thinking about, and maybe I'm not imaginative enough. I don't think I am to see where this would go, because you guys talked about data mining and back testing and things like that. And as quant researchers, all four of us have done that, and struggled with that and learned probably the hard way. A paper portfolio always does better than a real life thing. But one thing I've been grappling with is, can we vibe code a portfolio manager at some point, right? Like have them go through that entire cycle that probably took us 20 years to learn, but the code bit maybe, the agent can probably learn it in an hour. Be careful of backtesting. But yeah, I wonder if will we get to a point where you can vibe code a portfolio manager or vibe code your
intuition?
Yeah,
you can already vibe code backtest. I just was doing some this morning.
I bet. Yeah.
But can you vibe code judgment and creativity and the high senior skills that only the best top decile PMs? Because there's no point if you're a median PM. What's even the point?
Shops, right?
Yeah. Right. Yeah, if you're a median PM, then just buy the index, right? Like by definition,
I do think you can vibe code discretion, to the extent that we've historically divided investing into systematic and discretionary. I think discretionary judgments could very well be encoded into markdown files.
Yeah. So no, I was telling Sonu and Ryan before you got on, Steve, that I was just in Chicago at the University of Chicago. They had an AI conference where they brought together industry and then also PhD academics. And one of the big topics was this idea of implicit knowledge, right? Which is like, imagine you're at a big multi-manager shop or even just a traditional discretionary hedge fund. And you have a PM and he's like, all right, well, I do my thing. Like every morning I wake up, I read the journal, I listen to Facts versus Feelings podcast, get my ideas together. Then I do X. And when I listen to the earnings call, I look for these types of things. There's a lot of implicit knowledge baked into someone. Like the best example would be like these big names like Stan Druckenmiller, right? Like he seems like inscrutable. Like how does he think about things? Like maybe no one knows, but it's funny because when I use ChatGPT in my daily world and just kind of like type some ideas and then like spit out the memory file, it's pretty interesting because it's like, Kai Wu is X and he tends to think about the world like Y, Z, almost like a therapist. It's kind of reverse engineering my process. So in a way, like, Steve, we're quants, like we like to have rules which we can test. When you look at this earnings call transcript, look for these types of words. This language is negative. This is positive. Whereas like, that might be implicitly what others are doing, these discretionary managers, but they just haven't managed to explicitly codify them and then, test it, So I think in many ways, like AI, because of its capability and facility with unstructured data, provides this ability to kind of maybe combine, these two schools in a really interesting way. And I would assume that, as the industry moves forward, that is a direction where we continue to see progress.
I completely agree. I think we're going to migrate away from, looking exclusively at numeric data and towards using more text-based data that captures intuition and discretion of the sorts that exactly what we're just talking about, which should be for another great discussion.
Well, there's a lot of podcasts out there, but Steve, you and Kai, you guys maybe should do your own podcast together because the stuff you guys talked about today, my head exploded about 6 times. This was amazing. I know the listeners of Facts versus Feelings appreciate you guys taking more than an hour of your time to chat with Sonu and I. And I'm serious, like when Sonu and I were talking about all this AI stuff, 2-3 weeks ago, it's like you were the two we wanted. And thank you so much for finding time and doing all this. And this is episode 178. It might have been the best one we've ever had. I know this was really good stuff, guys. So thank you so much for the Carson community and all the listeners and everyone, all the listeners out there. Sonu and I'll be back next week. It'll just be Sonu and I. Kind of boring after this, but that's exactly. All right. That's all right. We'll keep doing these. We'll see everybody next week. Everyone take care. Thank you. Goodbye.
Cheers.
Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.